Hi, Matt Lewis with TechView Wealth Advisors. Today we're talking about the Mega Backdoor Roth for Google employees. We'll be covering the advantages, the disadvantages. I'd like to bring to your attention the common misperceptions so you can avoid them. Then we're going to take the first steps to set this up as a Google employee on the Vanguard site. And then finally, I will give you some tips on how to make the Mega Backdoor Roth even better. So let's look at the big picture. Let's fly 10,000 feet up in the air, look down on your 401k, see where the contributions are coming in. In this first box, there will be pre-tax contributions or Roth contributions. The limit on these is $20,500 in 2022. This is usually where people say, I've maxed out my 401k, even though it's only one of 3 buckets. If you max that out, you are going to receive the full company match from Google. And then we can calculate how large this box on top is. This is for after-tax contributions from you, the employee. And it's going to be $30,250 in 2022. If there were no company match, it would be as large as $40,500. And this is where we can convert these after-tax contributions to Roth through this Mega Backdoor Roth. The reason we're interested in doing that is because we don't want to pay taxes on our investment earnings. That's the whole idea behind this. One more thing, if you are age 50 or older, you could add another $6,500 to the bottom box. So as far as the advantages go, one striking advantage is that the contributions are so much higher than possible with a Roth IRA. You can put to work just $6,000 in contributions per year with the Roth IRA. And truth is, you probably won't qualify for one because your income is too high. The good news is that there are no income limits on employee contributions to a 401k. Next, you will enjoy tax-free qualified withdrawals. This is why we love Roth accounts so much. And lastly, you're going to enjoy more flexibility with a Roth 401k than a traditional 401k. For instance, you could pull out contributions early if you need to without paying penalties or taxes on those contributions. There are some restrictions and we will get into them shortly, but generally more flexibility. So let's compare the traditional 401k to the Roth. When you're making your contribution, the traditional 401k contribution will be pre-tax rather, and the Roth will be after tax. Then when you start taking distributions, you're going to have the exact reverse. You'll pay taxes on the entire amount of a distribution from the traditional 401k. You will have tax-free distributions from the Roth 401k. Required minimum distributions are required across the entire 401k, but there is a nice workaround for the Roth, we'll get into shortly. And then again, you're going to enjoy more flexibility with the Roth 401k. So what's the catch, you ask? Well, you do have to pay taxes before you contribute through the Mega Backdoor Roth. And there are some withdrawal restrictions. For instance, there's a 5-year rule. If you were to pull out money from the Roth 401k before the age of 59 and a half, and before the funds have been in there for 5 years, you will pay taxes and a penalty on the investment earnings portion of the withdrawal, and there's no way to pull out just the contributions. So that is a disadvantage. And then also, Congress had been trying to get rid of the Mega Backdoor Roth as recent as the end of 2021. That didn't happen, and it looks like we have at least a few more years before this pops up again. So let's use this investment vehicle while we can. Here are some common misperceptions I've come across. People think that any kind of Roth is off limits for them because their income is too high. That could very well be the case with a Roth IRA, but it's not going to be the case with a Roth 401k or the Mega Backdoor Roth. Also, I've heard people say they want to buy a particular stock and they don't think they could do that through their 401k. That is not true at Google. You can open a self-directed brokerage account through TD Ameritrade where you can buy ETFs, individual securities, and I think even options. The last reservation I hear from people, they say, well, the money's going to be locked up so long. Okay, that is true because we're talking about retirement planning, but you will enjoy more flexibility. You'll be able to pull the money out earlier and with less tax and penalty ramifications than with a traditional 401k. So let's talk about how to set up your contributions on the Vanguard site. Before you do that, you want to make sure that you're maxing out your 401k, your Pretax contributions or Roth Basic. You want to make sure you're getting the full company match. Then you want to figure out how much in after-tax contributions you're going to make. Once you've answered those questions for yourself, we are going to go on the Vanguard site and in the menu, look for Manage My Money, then click on Contributions. It will take you to a page with a table like this. I would suggest that you move the sliders from percentage to dollars so you can be more exact. And be cognizant of the number of periods left in the year because your after-tax contributions will have to be spread over that number of periods. Then at the beginning of the next year, you're going to want to revisit this page and reset everything. And hopefully then you can just set it and forget it for maybe that year or a couple years. But do be cognizant of the fact that the IRS will raise contribution limits now and then, and you want to take advantage of that. So let's keep an eye out for those changes. Once you've made all the adjustments here, go to the home page of the Vanguard website. You're going to scroll down and you're going to look for a section called Automatic Roth Conversions. Then there's a big red button, I believe, and it says, Set up my Roth conversions. Then you will click through the disclaimers, read everything, accept, and that will automate the process so that every payroll period, your after-tax contributions will map directly to the Roth portion of your 401k before any investments are made, and that way you can avoid taxes on those investment earnings. So once we have the Mega Backdoor Roth, how do we make it even better? Well, there's good news. The IRS doesn't view distributions from any Roth account to be income. So you can strategically manage your income and lower your taxes. You can avoid going into the next income tax bracket higher by doing this. And you could also qualify for lower premium on Medicare Part B. So you could strategically pull money out of your Roth accounts instead of your traditional 401ks, lower your income, lower your taxes, and lower your premium on Medicare Part B. Most importantly, you should consider rolling over the funds from your Roth 401k to a Roth IRA. And the reason for doing this is so that you can avoid required minimum distributions. Now, if you do this rollover, try to set up the Roth IRA 5 years before the rollover so you can avoid that 5-year rule that we talked about a little earlier. If you think your income is too high to open a Roth IRA, it's not a catch-22. There's something called a backdoor Roth that we will discuss in another video. And if you do this, you could delay your distributions. That might look something like this graph here. And you can see you could really build up your nest egg for retirement by delaying those distributions. I think we've modeled 10 years of delays here, so it is significant. All right, I am Matt Lewis from TechView Wealth Advisors. I hope you found that interesting, informative. If you have any questions or would like to discuss some issues with me, reach out by email or set up an appointment on my Calendly link. Maybe you have some colleagues or friends who would find this interesting. Please send them a link. And also check out our website where we have a section especially for Google employees. And then as a going away present, I've got this mandatory disclaimer for you. All right, I look forward to hearing from you.